Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to look at Chipotle Mexican Grill, ticker CMG. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments. I will get it up on the chalkboard behind me, which is pretty full, but I am going to start making my way through some of these here soon. I posted videos for Fiserv and Salesforce.com over on the free Patreon tier. So check that out down in the description. Go join over there. Sometimes the videos that are more complicated, I post over there, or if they're smaller business, those two weren't smaller, but I had covered them in the past on the YouTube channel. So whenever I have anything that I think fits better on the Patreon tier, I post those for free over there. But I will eventually get and make you a video if you request one, or I'll reply and tell you why, a video isn't worth it or whatever. As always, this is not individual investing advice, just how I analyze stocks. Okay, so Chipotle Mexican Grill, restaurant chain. Well, I assume everybody knows about them. We have data on the fast graph going back all the way to 2006, which I think is, that's a full 20 years. Funny story, I wrote an article on Chipotle somewhere in, I think it was 2018, and I was like, oh, here's the price where I think I would be willing to buy it, and that article came out, and it was basically right at the bottom, and it hadn't gotten to that price yet, and they announced the new CEO, who I think came over from Taco Bell, if I remember correctly, and I believe it's the same one that went over to Starbucks now. But yeah, it came out on the day my article came out. The stock bottomed, and then even with the recent decline, it's up 700%, so I missed out on that one. If you look at the earnings here, this isn't really the result of a normal cyclical downturn, which is usually what I'm looking for when I go back and look at historical earnings. This had more to do with they were having some issues with E. coli or some other sort of bacterial issue in some of the restaurants. Basically, people were getting sick, and that caused their earnings to decline, and then they kind of brought in a new CEO and cleaned things up a little bit and got everything back on track. And so it took a few years. I mean, basically, their earnings didn't recover to 2015 levels until 2021. So it took the stock price recovered faster than that. But earnings, they had a 6-year period where basically there was no earnings growth from the peak at least. And it took quite a dip in their kind of earnings trend. Then they got back on track, and now we're kind of where we are now. So if we take this little dip out of consideration, they basically had a good run, a great run actually. I'm not sure. They only earned 4 cents back then, and they earned $1.21, or they're expected to earn $1.21 this year. 3,000 something % return if you held the past 20 years. So doing really well in that regard. So the reason this is important is because we can look back and see what the earnings growth was like. Let me shorten this. So from the very beginning, earnings growth has been 22.5% on average. That doesn't average in these declined years, which is probably appropriate in this situation. So they've been growing at 20% a year, a little bit more than that, for 20 years, which is fantastic. And that's why the stock is done so well, and why the business is a $55 billion business. But recently we have the stock price telling us something, and it's down about 40% of its high. So that doesn't usually happen for no reason. But one thing I would note is it was at an extreme valuation of a 60 PE, which if they were going to grow 30%, I mean, if you look at the 1, 2, 3, 4 years leading into that valuation, you might have been able to justify it if you thought they could keep doing that for another 10 years. But what happened is earnings growth this year is only expected to be 8%. So when you go from a 30% baked in earnings growth rate assumption long term to 8%, the market will sell the stock off, and it could even sell it off more. Like a 34 PE that they're at now, they should really, to be a good value, they need to be growing earnings 20%. So the valuation still isn't cheap. And this is what can happen when you just pay too much for a stock. Like if you paid a 90 PE over here, you're only getting a 2% less than inflation return since 2020. Yeah. So 5 years with no return if you pay too much. That's why you don't want to pay too much. Especially for a business that's already pretty grown. I mean, you can go to any sort of reasonably decent sized town or city. I think I have like 50 or 60,000 in my town, and there's a Chipotle. So they've grown a lot. Like they're in most places that are the easy places for them to make money, most likely. And so growth is going to be harder to come by going forward. Just generally speaking, when you get that size, that's what happens. So I bring all this up because whether this is a good buy or not now really depends on how much you think they can grow earnings. Let's just put a time frame of like the next 9 or 10 years. What average earnings growth rate do you think they can do over the next decade? And if you can figure that out, you can figure out what you should maybe want to pay for the stock to get a good return. So how do we do that? Well, normally I look at the past and I say, okay, well, they grew earnings faster than 20% for 20 years, or more recently, even faster than that until this year. Maybe they can do that in the future. They've shown they have the ability to do that. But then I counter that by saying, well, that was before they had Chipotles everywhere, right? So now, and it also doesn't really include much of a recession. Obviously, COVID was a weird one, so we can't really count that. So we don't know how much people would pull back on eating out and things like that during a recession. And that would bring the earnings growth rate potentially down. They are not a small company like they were in 2008, where maybe they can just grow through it because they haven't expanded far enough yet. So maybe 20% is the maximum that I ever assume a company can grow over 10 years per year. So that's my maximum end. And then if we look at this year they're only growing 8%. So maybe they'll just keep growing 8%, right? That's the most recent. Maybe they'll beat by a little bit. So let's say they grow 10% this year. Well, that's a totally different growth rate than 20%, obviously. Compounded over 10 years is even more. So, and then analysts think that they're going to do 18% potentially growth the next couple years. All right. So really you just have to put all that together. And for me, when it's a situation like this, I look at what the analysts are saying. I think about how big the company is. I think about how much maybe they can expand. I think about how close we could be to a recession. If we're coming out of a recession, then they have more growth potential, right? If we're not in a recession yet, you have to factor that in because we'll probably have one in the next 10 years at some point. So what I'm going to do in this video is kind of show everybody what price would be reasonable to pay to get good returns, like above average returns, if you assume they can grow earnings 20% a year and then 15% a year or 10% a year. So that's going to be the goal kind of this video, so I can kind of frame things. I don't even know if I've totally made my mind up on which one to use. Right now, I think in my spreadsheet I have 20%, but that's just based on history because that's the default that I start with. And then when it starts getting close to a buy, then I take a step back. I say, okay, is that reasonable? Do I really think they can do that? And then maybe I'll adjust it down to 15, and so forth. So this is kind of how I go about making those edge case decisions, which usually are the ones that either can make or break you in terms of performing better than average or not over the long term. So the method that I'm going to use is the one I quite often use on this channel because it's relatively simple to understand and explain quickly. The idea is if you bought the whole business for any price, but if it's $100, we'll say, how long would it take you to earn $100 from the earnings of the business? Okay. And the assumptions that you need in order to do that, the metrics you need are the earnings yield, which is just the PE ratio inverted, and the earnings growth rate, which is this number here in green. You can also make adjustments. I sometimes make adjustments for debt. I'm not doing that in this situation. It doesn't look like they have really any net, like tiny bit of net debt. So I'm not even going to, it's not a big factor here. So I'm not going to worry about that, but sometimes I do adjust for that. So I'm using $1.21 in assumed earnings per share this year. So I'll be pulling that forward, which we're towards the end of the year, which is reasonable. Usually analysts are pretty close by the time you get to this time of year. I mean, there can be surprises, but so I'm going to assume they earn $1.21 this year, and they can grow that at 20% per year until you earn $100 back on a $100 investment. And I usually pull the first year of growth forward, right? So the way to think about this is if you bought the business for $100 at an earnings yield of 3.05%, you would earn $3.05 on your $100 investment that first year. I start off with 20% growth on top of that too. So I'm a little bit more generous. And so let's see, we get down here, I can show you how it works. So the first year you'd earn $3.66 on your $100. You get to keep that as the owner of the business. The next year you earn $4.39. You get to keep that. And so you kind of putting it at a piggy bank, and you want to know how long it takes to get the piggy bank to add up to $100. And the answer to that is, you can see it crosses the $100 goes above $200 in year 11. And that's the time until payback, 11 years. So my basic for an established business like Chipotle, I want the time until payback to be under 10 years. So usually it's basically in between 9 and 10, but the spot where it switches from kind of 10 years down to 9 when I'm doing this calculations is about what I roughly aim for. Right now the stock is trading at just under $40 a share. And with a 20% earnings growth rate, to get this under $9, you need it to be about $30 a share. So what's that? About 20 something percent lower, 25%, maybe a little less than 25% lower than where it trades now, if you assume 20% earnings a year for the next decade. Okay. Now, if you assume 15%, if you think, well, Chipotle is already pretty big, this year their growth is already slowing, growing 20% a year for a decade is hard to do, even if you're a smaller business. Maybe we'll do 15% a year. Okay, so when you do that with the current valuation, then it would take 12 years to earn your money back instead of 10. And the stock price would need to trade below 23 or at $23 per share before it would become a buy. That's when this number would fall below 10. So I can type it in here. Like if I type $23 instead of 39, you can see the time until payback falls down to 9 with a 15% earnings growth rate assumption. Let's see if I can get that back. There we go. Okay, so if you want to be even more cautious and perhaps realistic, they only grew earnings 8% this year. Use a 10% earnings growth rate. Now Chipotle is at a 15 year time until payback. This is about where the S&P 500 is right now, give or take 14, 15 years on average. So this is closer to what the market's pricing, which makes sense because usually the market takes whatever this year or next year is doing, and that's what they extrapolate out. So they're only growing earnings 8% this year. Then 10% is pretty similar estimate, especially if they beat by a little bit, which is usually what happens. And it takes 15 years to earn your money back, in line with the rest of the S&P 500 in terms of valuation, which is actually pretty expensive. Usually I sell stocks when they get around that 15-year time until payback area. And if you know anything about like PE ratios, it doesn't take a genius to figure out that if you have a 34 PE here, even if you pull forward, this year's earnings, growing at 10% with a 34 PE is a 3.4 PEG ratio. That's expensive. That's usually like you get over 3 PEG ratio. Usually you're thinking about selling, it depends on interest rates maybe for some people, and things like that, but it's definitely not cheap, probably not even like fair value. So that assumes that this earnings growth they had this year is what they're going to keep doing year after year going forward, rather than the 18% the market. One interesting part about it is when you do the math like that and you know where the rest of the market kind of is, you can tell that the market does not believe the analysts that they actually hire. So when it comes to these years projections out, if they really believed they were going to grow 18% going forward after this, the stock price would be higher, I think. So based on what everything else is trading at. When you do hundreds of these like I do, you start to get a little bit of a feeling and kind of like what the market's thinking. And you just run like the basic numbers. So if you do think, if you want to be pretty conservative and think they can grow earnings at 10%, then $18 would be the buy price, a little over 55% lower than where it is now. So there you go. I'll pop this back. You can see them, all three of them up here. If you want to take a look at that, mark it down. Now, this is dependent on what they earn this year. And then when we get into next year, if analysts haven't changed their mind and they earn $1.43, then the metrics will improve and the buy prices will raise. So I changed that to $1.43. That lowers that time until payback by a year. Maybe if we do 20% earnings growth, now you're, or 18%, which is what they think they can do. That's pretty cheap. That's almost a buy. But they have to keep doing that year after year for 10 years, which is very hard to do. So for me right now, it kind of depends on, I might do a combination where, I have a 15% earnings growth rate. If it got down below like $23 a share and then it looked like it was maybe making a bottom, I might use a combo thing where I'm kind of looking, okay, it comes down, when was it at 23? Probably just back here. 24, 23. Yeah, so 24. You could maybe even use that as a bottom, like a technical bottom level. So you'd be more like 25. These are all just estimates. So you think, okay, if it gets down to 25 and starts to form some kind of a bottom and earnings look like they're going to be at least okay, then that might be a spot to kind of come in with a small position, and see what happens. Obviously, if there's a recession or something like that, that's when you could get the bigger drawdown. That's when you'd be looking at the lower buy price, down what I say around 18, which I would say is going to be pre-COVID. I mean, that was a pre-COVID peak. So maybe not a bad second spot to look at when things are horrible. And that might be a spot where you're like, I'll take a chance. It's so cheap. Once things come back, it'll be okay if the market really overreacts, But that's how you make the big money, right? I mean, if you picked up this COVID bottom, even today after this 40% sell-off, you're up 260% or something. So it can be worth being patient sometimes to get those opportunities, especially with a bigger, more well-established business like this. A lot of people think that's a good thing. It can be. You can be more resilient. You have access to more resources and things like that. But it can also mean that growth is harder to come by in the future. So it's kind of a double-edged sword there. Okay, if you found this useful, hit the like and subscribe button. Don't forget about the Patreon tiers. I have weekly picks on Patreon for $25 a month as well. You can check those out. Those links are down in the description, and I'll see everybody later.